Hey guys, welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio, and this is our Disney analysis part 2. So to kind of recap, we were kind of exploring some of the risks present with the park and experiences, specifically with the Asia segment of that particular business segment. And then also we were exploring some other reasons to be potentially, bullish on Disney, which includes their wide variety of IPs and et cetera. And so now we're kind of moving on to part 2, where we're specifically kind of looking at our discounted cash flow analysis, as well as creating our discount rate we're going to be using for said analysis. So Fabio, let's take it away, man.
Yeah, so first, what I'd kind of start to highlight is a little bit about the performance of Disney over time. So if you can see here, Disney, since its IPO, has been more or less up and to the right. Understandably so, they've gone through several transitions. And Austin, what have they been doing from the 1990s? What was their strategy?
So I know that in like the late 1990s, early 2000s, that's when they began kind of that strategy in their studio of acquiring IPs. So they first acquired Pixar, et cetera, et cetera. And so we can kind of see that price into here, Fabio. I think you might have been telling me earlier, correct me if I'm wrong, that at one point, as the stock was moving, that was kind of when the hype was kind of following Disney. And then there were these massive periods, as you call it, of underperformance. Would you elaborate a little bit more on what that means?
Yeah, so like with any kind of investment or any company, sometimes there can be periods of exuberance, and they can go through periods of like where they're growing really fast and everyone becomes overly optimistic, and they think, oh, it's good, the growth is going to continue forever. And sometimes reality can kick in and you can have periods of severe underperformance. So for example, if you were buying at any period from 1998 to around 2001, right? How many years is that, Austin? That's about 3 years. If you bought anywhere within that 3-year time period, you went nowhere for the next decades, right? And then it's only until here in 2011 where you really start to see some overperformance in the short term, right? Because here you could say that people became pessimistic and then the company was advancing faster than the fundamentals. And at that point was actually the moment you wanted to be bullish on the stock, right? And then you follow a period of overperformance. And I'm not saying that we're in a period where the stock is potentially a little gotten ahead of itself, but it's something to be aware of, that a lot of companies do follow that pattern. It's kind of just like general rule of investing. You want to be careful that you're not buying or you're not greedy when everyone else is also greedy, because then that could actually hinder your performance, because the whole point of picking individual stocks is to outperform the market, to outperform the what you otherwise could, because there's an opportunity cost in investing, right? You're taking on additional risk by choosing an individual company, and you have to therefore justify that added risk, right? So actually, I think we can go ahead and go to the model.
Something I actually kind of want to note that might be like a potential deterrent to some of our new viewers. This is Fabio's and I specific investing philosophy. And like we kind of said, Chris at Strongman Personal Finance, who thank you for having us on your show, by the way. Like we were saying on there, like what you want to do is you want to find like the strategy that kind of works for you and then stick with it. So for me, for example, I'm fine with having a market average rate of return through my index funds, but then I would also like to take the added risk that maybe some of my individual picks might do better. Maybe they won't, maybe they will. That's the risk that I'm personally choosing through that. So now, Fabio, kind of focusing back to this model here, we kind of decided during our first part, at least I decided, that due to the risk present in the VIE structure of the Asia parks within their business segment of the parks and experiences, that I would want a 15% required rate of return. Now, is that something what is otherwise known as a discount rate, but is that something, Fabio, that you would agree with, disagree with? Would you go higher or would you go potentially lower than my discount rate here?
For a company like Disney, it depends, because we would have to actually go and measure the risk of those VIEs and what they have for the rest of the business, which I don't think is much, actually. I do think Disney is a very high quality business. It is a business I would actually consider owning in my personal portfolio at the right price.
Same here.
What that discount rate for me would be, I'd say between, yeah, between 12 and 15%. If anything else kind of surfaces, because the whole purpose of part one was for us to kind of uncover any risks we might see. And it just so happens that's just the only risk we really saw. We didn't really see anything else that was very drastic. So I'd say anything above like 12%, I'm okay with. But I have to be pretty confident on what the growth rates are going to be, which we can actually get into. So I'll go ahead and actually put in your discount rate. I'll assume a 0.5% buyback. Now, there's something we're going to go over with our audience real quick. So if you do your own analysis at home, you want to make sure that you're paying attention to some nuance, right? So right here on the, let me make us smaller so our audience can see. Right here on this line item, cash flow from operations, I would highlight that Disney has gone through a turbulent period, to say the least, right? So from 14 billion over here to down to 4.5 billion over here. So what we see here is there is a one-time, seemingly a one-time change in income taxes right over here. What we want to do to kind of patch this up is try to normalize this. Let's keep CapEx the same. If we want to be a little bit more conservative, we can say CapEx is somewhere along the lines of the previous year.
Yeah, I would
it's
just
not going to
pull
be
over the previous years. Yeah,
it's not going to be an exact number, unfortunately, but we're trying to normalize the cash from operations because we can't take 2020 because 2020 is a pandemic. And 2019, we seemingly have a one-time change in income taxes expense right here, cash coming out of the business. Now, what I highlight here is we have a upside surprise, which is generally a positive thing. So if we just, do some rough math, that's about 10 billion in free cash flow with net income of around 1 billion. So that's generally a good thing, right? So now let's go back to the summary report now that we have this corrected.
So kind of just jumping in here for a quick second, basically what you're kind of looking at here for those of you watching right now is kind of where the art of investing and the science of investing makes sense. We don't entirely know yet what the cash from operating activities will be for the year ended 2021. So we're making assumptions based on the cash flows of 2018, for example. And that's kind of where we're blending the art and the science itself that kind of filters into our discount rate and actually our discounted cash flow model itself as well. So Fabio, please continue.
Yeah, so now actually all that's left is to pick out the growth rates going forward. And we're going to keep that at 10-year model. We can lower the model years, but let's keep it at 10 years because we're long-term investors. And let's actually assume a buyback of 0.5% per year. We can see here, based on those current cash flows and the current market cap, they're capable of doing 3.21% without incurring debt. So that's just from the free cash flow available. Ignore this. This is actually from the acquisitions they've been doing. So they've diluted shares. But if you look beyond that, so before that, if we go to the balance sheet here, and we actually
shares
go up
outstanding
here. Yeah. Total common shares outstanding. So let me actually move us around so everyone can see. We can see that from these 2 years, from 2017 to 2018, it was actually a decrease and then went back up because they did this acquisition. So that's a little bit of nuance. And then they actually started buying back shares again a little bit here. So I'm going to assume going forward that they return capital to shareholders in the form of a buyback of about 0.5%. And adding that in, I'm now going to pick my growth rates. So I'd say conservative growth rate would be for Disney. Let's assume Disney Plus is going great and 10% a year compound over the next 10 years. Then let's go a little further. Let's go 20% compound for the next 10 years. Then let's go a little more aggressive. Let's say 30%. All right. And then let's go in the middle. Let's say 25%. And then let's go
5%. Why not?
No, 22.
22%.
Yeah, because we know we don't need to do 5 because below 20, it's already not a buy at this current required rate of return. Now we can play around with this required rate of return and see kind of like what you're expecting from this business. So that just because we're using discount rate of 15 doesn't mean that that's the appropriate. Like, what if you're okay with, I don't know, let's say a 7% discount rate, you see?
Wow.
So
Yeah,
7%
that's pretty
discount rate.
incredible. Can we try
You,
market average, Fabio? We throw in a 10%.
yeah.
All right.
So you're actually in between 10 and 20. It's somewhere in there. So I can
Would you
throw
change
in,
the 22 to a 15%?
yeah, let's do that.
Just kind of want to see.
You see, it's
Interesting.
around there.
Yep.
It's around a 10% rate of return if you assume a 15% growth rate of the business.
Yep.
Let's go a little bit lower. Let's see if 13. So
So
13
that's
is
like
close
right.
enough. And then
14.
14 is right on the mark.
Mhm.
If you can get like a 14% growth rate of return, you can kind of average it out. Assuming again, this buyback does happen. If we don't want to assume the buyback, I'm going to be a little more conservative and not even count the buyback. We just don't account for it. And now we see a different buy price, but it's not that much because the buyback I'm assuming was pretty negligible. And looking.
So
Mhm.
yeah, go
I was
Fabio.
going to
Sorry.
just quickly check here some of the metrics. So the metrics that we really care about is over here. So price to free cash flow after the adjustment is 31. And the PE, you can see here, the PE on a GAAP basis is ridiculous. Let me actually go here to Seeking Alpha, and we can actually, they always like to use the forward PE on their front. Yeah, so you see the forward PE is 70 on this company.
Mhm.
And I believe that might be on a non-GAAP basis that they're putting it out. That would be in value, which is
So
there.
Fabio, would you also kind of explain to our audience too what forward PE is in essence? Because we see a lot of people in YouTube specifically basing almost an entire investment thesis off of the forward PE. So Fabio, would you
Mhm.
kind of walk through what the forward PE is, as well as what it could potentially tell you, as well as some of its pitfalls, for example?
Yeah, so the main pitfall of a forward PE is it relies on estimates by analysts because it's not an event that has occurred yet. So you have GAAP and non-GAAP. So non-GAAP forward is actually what's being quoted on Seeking Alpha, which is even well, it depends on your opinion because when you go non-GAAP, you're exiting the regulated form of accounting, generally
Yeah.
accepted accounting principles, and you're entering the customized accounting principles of the business. So the business is giving you non-GAAP because they say, okay, well, this represents the business better than GAAP standards. And then supposedly, it's
So
debatable with professionals, but yeah.
with non-GAAP, what non-GAAP is used a lot of the times for is actually management.
Yeah.
And it's used a lot in like cost accounting and et cetera. And what happens is they report this out of good faith, showing investors good faith, like, oh, these are the numbers that we're using for X, Y, and Z, certain projects we're taking on X, Y, and Z, et cetera, et cetera, et cetera. And they're reporting these numbers out of good faith. So typically when a company shows me that they're reporting non-GAAP numbers, I typically like to see that because that means, okay, like we want to show our investors numbers that we're using internally, that we as management are using internally to derive certain valuations of things. So anyways, continue, Fabio.
Yeah. So with that, we can kind of see what the PE is. It's pretty high. We're almost like on par with Seeking Alphas here on a trailing 12 months, give or take a little bit. But what I want to highlight is on a forward basis, on a GAAP basis, they're still really high. So I wouldn't pay too much attention to that. I'd say again, there's an upside surprise. So I'd pay attention more to the free cash flow the business is generating, which actually paints a nicer picture, makes it look less overvalued. Doesn't mean it's undervalued, but it looks a lot less overvalued than previously if you just use a GAAP metrics. Now, based on the GAAP metrics, you can kind of see it. You have to ignore return on assets and return on equity because these are being calculated on the net income, right? Not on a free cash flow basis. So these look really low, but they'd actually probably be a lot higher. We can take a look quickly at key ratios before we start wrapping up. And again, Disney is a fantastically run company. You can see here, they have dips in the current ratio, which is interesting, but now more or less they're above, right? So they're above 1. We'd like to see above 1, and then they seem to have improving cash ratios. So a lot of things are improving. So these are decreasing on this end a little bit, increasing a little bit on this end, but decreasing from 2020. And these are the ones I paid more attention to, not so much activity ratios like inventory, stuff like that. I wouldn't really care about that with Disney too much. Now, this is something, again, I hearken on earnings quality. So you can kind of see here that this is kind of hinting at an upside surprise right here. It means that on a GAAP basis, it's reporting less income than actually of the cash that's coming in. So they're recognizing certain costs now on a GAAP basis. And then, but the raw cash that's coming in is far greater than that. So again, that again further solidifies this thing we were talking about here, that on a free cash flow basis, the 31, which is not cheap, because if anyone knows about like the PEG ratio, and I would reference
price to earnings growth is the PEG ratio.
Peter Lynch kind of devised that and talked about how a business is not overvalued. For example, if there's a P ratio of 30 or whatever, price to free cash flow of 30, whatever metric you're thinking about, and then it's growing at 30% per year, then it's actually at fair value. So normally back then you would say, oh, a P ratio of 30 is really expensive. It's like, well, hold on. If it's growing at 30%, it's actually fair valued. And if it's growing faster than that, it's undervalued. And that's what the PEG ratio is supposed to measure. Now, I don't know if Disney will be able to grow at 31% a year. But again, there's an implied premium in this kind of business. Whether or not that's justified is up to the investor. We don't have the answer to that. That's the thing about investing. It's we can have differing opinions as to what the true value of this asset is. We can discount the cash flows to tell you what we would be willing to pay for something. But at the end of the day, you can decide based on the required rate of return, what premium are you willing to pay? If you're willing to get a lower return, you pay a higher price. If you're wanting to gain higher returns, you have to, by definition, wait for lower prices and acquire assets at good prices, and good quality assets at great prices, you're going to do extremely well. So Disney is one of those really good quality assets that if you could get it at a decent price, you're going to do pretty well. Your portfolio will do really well.
So Fabio, something else that I kind of want to explore too. If you go back to the key ratios and we kind of take a quick look at the book value. Okay, so we're seeing a pretty incredible increase in the book value per share between 2018 and 2019.
Right here.
However, Fabio, when I was kind of doing my preliminary research on Disney, I noticed that a substantial amount of assets on their sheet consist of goodwill. Now, does this kind of pique your curiosity a little bit? Because it definitely piqued mine in regards to the book value per share. What are some things that like the retail investor who has an affinity for looking at the book value per share, what are some things that they might be potentially missing out on if they decide to just simply look at the book value per share without taking into account the role that goodwill is playing into that itself?
Yeah. So for anyone that doesn't know, maybe Austin can elaborate more on Goodwill briefly, but I personally, I like to be a little more conservative with that. And I actually like to take out Goodwill just simply because I prefer to err on the side of a more conservative investment. In other words, I don't like to make too many assumptions. If I assume that management is judging things fairly at fair value, that's an assumption that I'm making. Unless I can somehow get a certainty that they're doing so, then I might, consider just not caring about Goodwill and just allowing it to stay in. But if I take out Goodwill, I don't have to assume. Like if the investment makes sense for me, even after taking out Goodwill, then I'm kind of implying there a margin of safety of my ignorance. And that's what I'm doing as an investor, because the rule number one is not to lose money. And I want to be in positions where I know that even on the downside, even on the not as good of a scenario happens, I'm still going to come out somewhat on top.
So yeah, basically just to kind of echo what Fabio said, for some of you who might be watching, what Goodwill is, there's a lot of uses for Goodwill, but a lot of the times people like to use Goodwill specifically for in acquisition accounting. So what happens is there's multiple different ways to calculate this, but management kind of comes up with a valuation of what the business could be. And then they take the net assets and liabilities, which net assets of the business, and they subtract it by that. And then that excess typically flows into Goodwill itself. So basically, if any of that sounds confusing, what you should know is that Goodwill, in essence, is basically an account that tracks companies making investments. And then what happens is the GAAP accounting requires that these companies impair Goodwill if those estimations they made regarding the business they just acquired have proven to be different, for example. So a lot of the times you'll see like impairment, like goodwill impairment as an expense. And that's exactly what that is. That's management assessing the goodwill asset account and then being like, okay, it's actually valued here, even though our original estimates were here.
Now, Austin, all right. So just to clarify for the audience, do you think it's a problem in your opinion? Is it something you should be concerned or no?
So I'm not going to make
Disney.
any definitive statements of fact. For Disney, I am in essence trusting the management here and saying that the management, when they're arriving at these assumptions of goodwill, I am trusting that what they're putting on their balance sheet is actually what it is. Now, the big criticism that people have with goodwill is that management can be overzealous about goodwill. Management can be overzealous about goodwill and say, oh, this company that we're acquiring is going to make us wild amounts of profit. And then in essence, what ends up happening is their assets on their sheet end up overvalued. And then through the impairment process, that gets reduced down. I do not exactly see a big risk of that happening through Disney, Fabio, to be perfectly honest with you. And it's because a lot of their current operating officers, I was not able to find prior histories of fraud, for example. So here, and because Disney's such a large company, here I'm willing to trust what management is putting down for goodwill, in essence, to answer your question.
Okay. So yeah. So that's, for our audience, that's what they wanted to know from you. Did you think it was a problem? All right. So we don't think the goodwill is a problem. We love the intellectual property, right? We love pretty much the business model of Disney. The main risks we found in part one of this video series about Disney is simply the structure of the assets in Asia, particularly Hong Kong and Shanghai. We didn't have a problem with the way it was structured in Japan, and pretty much anywhere else in the world. I did mention briefly, I think in the last video, if not, I mentioned in my other China video about the capital restrictions that may pose a risk for those assets, as far as moving cash, because cash is only as useful as much as you can use it. And aside from that, there wasn't really much anything, just a really solid business and diversified in all these forms of entertainment, whether it be cruise lines, media, direct to consumer through Disney Plus, which we're really bullish on. I'm a Disney Plus user. I don't know about you, Austin.
Me too. I also am as well. Yes.
All right. So yeah, we're very familiar with the IP. So what it comes down to for me as closing thoughts, it's just, I want it at an attractive price. So for me, if actually, let me share the model again. Let's, I would say for me, I'm comfortable with getting this at around between $137 and below. If I could get it, I don't think I will get it at 72, for example, because I think that there's an implicit premium with this business. So
and I would definitely also agree with that too, because this business isn't just any old run-of-the-mill business, Fabio. This business is Disney.
So what I would do is like a plan is I would scale or start to scale it in a position at below 137.75, because I'm not comfortable with assuming a growth rate too much greater than 20%. I think that's pretty excessive. And unless I can somehow change my assumptions in terms of the buybacks, which actually, if I think the company is overvalued at the moment, I don't want them to be buying back shares because it's in essence destroying shareholder value. So I actually wouldn't want them to be buying back shares. I'd want them to accumulate cash. And in the event that things come down, or like just reinvested in the business, but in the event that the share price does come down, then I would like them to hopefully buy back shares then. But that's a side note. So I would probably be looking for anything above or start scaling below $137. And
so for me and my closing thoughts here, I would probably actually agree with that too, but I'm going to wait specifically until the end of the year when I can read their 10K 2021 and I can actually see the actual amount of their cash flows at year end. And then I can actually correctly place that into this model itself. And then I'll probably reassess from there. The thing about Disney is a great business. Disney's a fantastic business, although I'm not sure the price is exactly right for me personally.
Yep. All right. So you heard it here, everyone. Thank you for watching. Make sure to check out our website where we have a article just on Disney, and be sure to watch our next upcoming video on Rocket Mortgage. Thanks, everyone. Have a good one.